Welcome back to Rethinking a Dollar. Today's my guest is Charles Hugh Smith, a former guest here on RTD. He's the creator and editor of the popular blog of twominds.com. Charles is an author of many great books and writes daily at his blog, keeping the world informed of what's happening with the economy as well as our monetary system. So Charles, welcome back to Rethinking a Dollar.
Thank you very much, Mike. It's my pleasure to be here.
Well, I appreciate you sitting down, taking time with me. I enjoyed our pre-interview conversation. Definitely got a chance to know more about you and vice versa. So I want to just dive in right away. This week has been a big week with all the meetings happening and whatnot. But before we actually talk about those things, I want to actually get your take on what's Charles Hugh Smith keeping an eye on these days as we wrap up 2016 pretty soon. What's on your mind? What's concerning you?
Well, Mike, I think like a lot of other people that look at the economy and monetary policy, I get the feeling that the central banks are running out of rope, and that that what they've been doing for 8 years is getting what we call diminishing returns. It's becoming less and less effective, and we see it in a lot of different countries, not just in the U.S., but like say in China, where they have to create huge amounts of debt just to keep their economy from going into recession, right? Yeah. So I think that we all know that it's coming to a crunch time when central bank policy is going to fail or no longer have any effect, and then so we're all kind of wondering, well, what happens then? And of course we're looking around for triggers, like where will there be a crisis that will trigger something like the central banks going to helicopter money or some other policy extreme that will fail to fulfill their expectations. And some people are looking at the election, like if Donald Trump wins, would that upset the apple cart, or would there be a credit crisis in China, or would Italy default? And it's kind of like a whack-a-mole here in terms of crises that could trigger something. But that's what I'm looking at.
Yeah. Now, out of all the things you kind of hinted at, what seems the most obvious that any minute now something can happen that can really shake things up?
Mike, I think that we're in an interesting and kind of unprecedented situation, because any problem in the world that can be solved by creating another $1 trillion and giving it to somebody, those problems will be solved. In other words, like if a bank defaults, well, the central bank can just print another 1 trillion yuan, euros, or dollars and bail out the bank, right? And so we have to look at like what problems could come up that the central banks can't resolve by just printing some more money. And one of them is inflation. Because eventually, when you print a ton of money, eventually you're going to get inflation, and so far we haven't seen it. But if inflation starts kicking up a little bit, then the central banks will really be in a tight spot, because they can't just throw more money at that problem. Throwing more money is like throwing gasoline on the fire.
Right.
So and that might be a long trend, right? In other words, we won't see necessarily a spike of inflation from 2% to 10%, but if it starts creeping up to 3%, 4%, that's going to put a crunch on central bank money printing.
Now, do you think that's kind of why the topic of adjusting the inflation rate is mainstream right now, as far as them wanting to actually on their side say, okay, let's move it to 3, 4, so that when it actually hits 3 or 4, it won't be a surprise to people because they've already gave you a warning or told you that's what it was going to be, or that's what their aim was?
Mike, that's a great idea. That's very likely what they're seeing is that like by some measures of inflation, well, by my measure, it's really running about 5 to 7%.
Yeah.
But officially, it's like 2%, but it's creeping up to 2.5%. So you're right; they're probably anticipating that all this money printing is going to push it more to the 3 to 4 range. So they're saying, oh, that was always our plan. But the problem is, as we all know, is in the past, when central banks, did their stimulus and inflation kicked up a little bit, like in the 70s, well, wages went up with it. So people, were able to compensate. Maybe inflation was running 5 or even as high as 10%, but they were getting more income, and so they could still survive. But now what we see is all wages of the bottom 95% are stagnating, right? They're not really going up enough to even match 2.5% inflation, never mind if it gets even hotter. And so that's why we talk about helicopter money is the central banks can't force employers to pay their employees more money. And so how are you going to get people's wages up?
Right.
And of course, from the employer's point of view, their costs are going up because of healthcare. So, you know, if I'm an employer, I might be going, well, I'd like to give my employees a 5% raise, but guess what? My health insurance premium just went up 27%. So I got no money to give to my employees. So, you know, it's like everybody's getting squeezed here. And so the bottom line is, if you can't raise wages, then inflation's eating away at our purchasing power, making us all poorer. And that's something the central bank can't really fix.
Right. And one thing I noticed is an increasing trend of other, you know, mainstream media, financial gurus and experts and advisors saying, you know, times are tight. You got to just spend less and save more. And I'm thinking about they're encouraging people to save, 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 but yet they're saving in institutions that are, you know, are gambling basically with their money and they're not getting any return on it. So just the conventional wisdom of save is kind of lost nowadays, because how can you save and actually allow your money to grow when you're not being given anything?
That's right. That's right. 0% interest, or a tenth of 1%. And yet the irony of this, Mike, is that the central banks want us all to go spend every cent, right? Not save anything. They call that hoarding.
Yeah, hoarding. Yeah.
That's crazy. And so that's crazy, because actually savings is the basis of capitalism, right? We put our savings, and then the bank loans it to somebody that's supposed to be starting a business or doing something productive with that capital. But what happens is if I'm not making any money in my interest accounts, well, then I got to save more, not less, because I have to save what I used to get in interest. And so the central banks don't seem to get it, that they're creating a feedback loop that's actually doing what they don't want. You know, by denying us any interest, then we all have to save more,
Right.
not spend more.
Right. I a while back just kind of caught onto the whole cash back thing going on now, where they have celebrities, you know, selling credit cards or whatnot, and how everything that I do myself comes at the bottom of the statement. It says, you know, you receive X amount of dollars cash back. And my thought is, I don't want cash back. I would prefer to earn some. Or rather my money sit with you and it earns something, as opposed to me having to spend to get some crumbs back off my money. So interesting concept, man. Interesting where we're in. I wonder how it's all going to end ultimately. So it won't be pretty, I'm sure. Now let's get a little bit. Let me get your take on you know, Janet Yellen's you know, the whole announcement yesterday. Everyone was glued in, waiting to hear, you know, will she hike, will it not hike? Summarize what she said, and then give us a Charles Hugh unedited version of what she said actually.
Well, that's an interesting topic, and I'm not sure I'm breaking new ground here, but you know, we all know that what's happened for like 8 years is that where the economy is supposed to be growing, the central banks have dropped interest rates to basically zero. And that the idea was to encourage more borrowing and spending by consumers, and then more investment by businesses. But what's actually happened is those of us in the bottom 95% haven't really seen our interest rates on our credit cards or student loans drop much.
Right.
And so it's really all this free money is going to like corporations, who are then using this, borrowing a ton of money or selling bonds and using it to buy back their shares. And so they've boosted the wealth of the CEOs and the top management. But outside of that sort of speculation, a lot of this credit hasn't really flowed into the real economy. So the central banks have been waiting for this you know, big boost in consumer borrowing and spending. And the idea there was, once that happens, then we'll raise interest rates, right? Well, it's never happened, so they've never raised interest rates. So now the analogy a lot of people use, right, is they've run out of bullets, right? They've been using all their tools to keep interest rates at zero. And now that the economy's sliding into recession, they've got no tools left. And so the thing is, well, if they raise interest rates now, then they can drop it in 6 months when they admit the economy's in recession.
Right. So,
but it's kind of too late.
do you think, just from the data and everything that's been released, I've seen a lot of graphs showing a downward trends in pretty much everything that's measured. So would you say that we're currently actually in one now, waiting for it to be officially announced, or you think it's something that's to come still?
You know, Mike, I think we're in recession now, and the reason why I think so is You know, when they issue the announcement of the GDP, the gross domestic product, it's like a nominal number. Like they don't adjust for inflation, right? They say, well, you know, the economy grew by 2%. Well, if there's 3% inflation, then the economy actually shrank by 1%, right? So they, by understating inflation, they've kind of gamed the system, make it look like the GDP is actually rising. And they use a lot of funny, you know, they call them deflators, right? Like they deflate the actual thing with like adjustments like substitution and hedonics and they to me they understate like college tuition, health care. They make they diminish those the real impacts by making those a tiny little part of the inflation calculation. The net result is if you believe like I do that real inflation is above 3%, then the GDP, once we adjust for inflation, is already negative. So they've managed to make it look like it's positive by understating inflation. That's one basic measure.
Yeah. So do you think they'll wait till there's some type of hiccup in the system after next year to then come out and say, yeah, we are officially in a recession? Or do you think they'll just let things play out to where people begin to recognize it and then the media talks about recession, then the Fed will come out and recognize or admit that we're in a recession? How do you think it'll play out, you know, in the long run, this year or next year?
Yeah, that's an excellent question. And if they keep playing around with inflation, maybe they'll be able to make it look like we never were in recession. You know, like the GDP will grow 0.1%. You know, some tiny sliver, so they can avoid that. And that may be one way they play out. Or it may become that growth in the U.S. falters so badly next year that they have to admit that the economy is in recession, you know, even with all their trickery. Yeah. And that to me is really likely. You know, like we look at auto sales, we look at borrowing, we look at new business startups. You know, all that stuff's just falling apart. So I don't see how that trend is gonna keep us out of recession. So, and I would guess like first quarter of next year or second quarter. I don't think they can put it off. But like I said, they might, and they might be able to make it look like we're growing at, you know, 1/10 of 100th of 1% or something,
yeah,
just to avoid recession.
Wow. Now let's talk about the banking sector. Everything now, the Wells Fargo fiasco with all those fraudulent accounts. You know, why now? And why not? I mean, they've known about it apparently for a couple of years, but all of a sudden hit mainstream media now. Do you think it's, you know, brought to the light as some type of diversion tactic along with many other things? Or is there, you know, something brewing in the banking sector here, you know, period?
Well, that's an excellent question, Mike. And I think what we need to look at is why are the banks having trouble making money? Well, they have trouble making money for two reasons. One, many of their customers already have too much debt, right? People are struggling with student loans, so they can't take out a new auto loan, or they can't buy a house and get a mortgage. That's one problem. And so the other problem is, you know, by keeping interest rates near zero, the central banks have really hobbled the bank's ability to make a profit, right? Because, you know, if mortgages at 3.25% and the bank has to borrow, you know, at 1 or 1.5, then it's like, well, gee, their profit margins are a lot smaller than they were, say, 10, 20 years ago. So then the banks are like, well, how do we make money? And then fraud comes up as a as a pretty easy way to do this, or maybe the only way. Yeah. You know, in other words, maybe the only way Wells Fargo can generate profit nowadays is with some form of fraud. And it's kind of so this is another kind of negative, like we call it, perverse incentive of the central bank policy, right? Like this was supposed to save the system, but if we look beneath the surface, we find that it sets up all these negative consequences, and banks struggling to make money is one of them.
Well, I hope you enjoyed today's interview thus far. I want to direct your attention to the subscribe button. If you're enjoying it, subscribe for more great interviews to come, as well as go over to facebook.com/rethinking the dollar and give me a like there. I share monetary news on a regular basis. Looking forward to bringing you more interviews. Back to this conversation.
Yeah. Now, do you think there's other banks that will be brought to the light as well, or this is an isolated event, or if Wells Fargo is struggling, it's good to say that all the other globally systemically important banks are also probably doing the same thing. Will it all come out at the same time, you think, or this will be the only case we might hear about this year?
Yeah, that's hard to know. But I suspect that all banks are playing some sort of game. And say Deutsche Bank in Germany, they've got a bunch of derivatives, right? So they've played around with hugely risky bets as a way to make money. So I think we can say with confidence that the banks have been pushing the limits of the sector either by fraud or by really risky speculation to try to make money in a low interest rate environment. And they've been pushed to that extreme by the central banks.
Yeah. Wow. Wow. Let's cover the whole SDR, special drawing rights. I guess in the next couple of weeks or a week or two, the yuan is going to be added. Give me your take on that, and will that be something that will be a major game changer for the Federal Reserve, or what are your thoughts about that?
Well, let's start with what an SDR is, special drawing rights. And what it really is it's a basket of existing fiat currencies, right? And what we mean by fiat currencies, your listeners know, it's just money that's not backed by anything, right? It's issued by a central bank somewhere in the world, and it doesn't really have anything backing it up. So by taking a bunch of weak currencies and putting them into one basket, you got a weak basket, right?
Yeah.
I mean, here's one currency that's backed by nothing, another currency backed by nothing, another currency backed by nothing. The basket's only as worth as much as the weakest currency in the basket. So I don't think SDRs are the game changer a lot of people feel. And I think that the Chinese yuan, the only way it's ever going to establish itself globally is if they allow it to float freely, which means let the market decide what it's worth. And the central authorities in China obviously hesitate to do that because they're afraid that maybe it's going to go against them. If they want the yuan to stay cheap, maybe it'll go up in value, or maybe it'll devalue so fast on the open market that then they'd have a banking crisis. So they want to control things, but it's you can't have it both ways. If you want to control your currency and peg it, then you're never going to have a global currency because nobody can trust that. And there's not it's like, well, how do I know they won't devalue it tomorrow, right?
Yeah.
So a market is the only trustworthy mechanism. And so that's what the Chinese authorities are going to have to do. Is the SDR is meaningless in my mind. What's really going to be meaningful is if they let the yuan float completely free, which means I disconnect the peg to the dollar.
Yeah, wow. Now, how does gold and the gold rush happening out east kind of all tie in with the SDR and the yuan, and why do you think there's such a ramp up in gold out east and not really mentioned here? For our central banks on this side of the waters for the most part.
Right. I think that's an excellent topic, Mike, and I'm really glad you brought it up because I have a lot of friends in China and people that are here that go back and visit for business and stuff. And so the thing about the Chinese economy is, it's been running hot, for like 20 years. And there's a lot of debt in the system. There's a lot of risk. And so the Chinese people recognize that the way that this is probably going to go is their currency, the yuan, is going to get devalued, right? And so so that means that their purchasing power of their yuan is going to decline. So that's what happens when the currency depreciates, right? Like suddenly, your money's worth less in the rest of the world. So what do you do to protect yourself? Well, you have a couple of mechanisms. One is you can buy something that's going to hold its value while your currency goes down, and gold and silver are historically good hedges against that, right? Because your gold is going to hold its value as your currency loses value. The other thing is you take your money out of yuan and you put it into Canadian dollars and you buy an apartment or a house in Toronto or Vancouver, right?
Yeah.
Or you buy dollars and you're buying apparently a lot of that Chinese money's flowing into Seattle, Portland, San Francisco, and New York. And in the same way, money from South America is flowing into Miami, and so the U.S. has been you wonder, why are real estate values so high here? Well, a lot of that is because other countries, the people there are recognizing, gee, what's the likely thing that's going to happen is my money's going to devalue, so I better get gold or real estate or something that's tangible. And so that I think explains the gold rush in the East.
Right, right. Now, I want to get back or just cover the idea of, can you foresee a reserve country or reserve currency status, or the Federal Reserve, wanting to or being forced to implement negative, like true negative interest rates directly, or what? What do you think? Because some people say, it's the Federal Reserve. I mean, it's the reserve currency. They can't go negative. And I'm thinking, like, there's a lot of things that I wouldn't have believed they would have been able to do. So I wouldn't put it past to actually say, okay, we have to drop it below, and this is what you're going to get. What are your thoughts about that?
Yeah, that's another excellent topic, Mike. And I tend to get I have my own kind of hit on that. I understand that it's those people that think the Federal Reserve is going to follow all the other central banks into negative interest rates. Why not, right? That's the mindset of central banks, is we're going to force all those hoarders and savers to spend every dime they get to, keep the economy growing, right? Because they're afraid that if the economy stops growing, then no one can borrow more money, and then the whole banking system collapses. And they're afraid of something legitimate. My take on it is the U.S., as we know, has a lot of problems. Well, other countries have a lot of the same problems, right? There's too much debt, wages are stagnant, all that stuff. But one advantage the U.S. has is it has this global reserve currency, the dollar. And so if you lower interest rates to zero or negative, where people don't earn any money for buying a U.S. Treasury bond, well, you're going to lose that capital flow of all the money around the world coming into U.S. Treasury bonds, because they're still paying a positive yield, right? I mean, there's still like a 30-year Treasury is like, I think it's 2.3 or something, and a 10 years like 1 point something. Well, hey, 1.5 looks real good compared to minus 1.5, right?
Yeah.
So the U.S. is benefiting from this huge flood of capital from around the rest of the world, from institutions seeking a yield, a positive yield. So I think if the U.S., if the Federal Reserve lowered interest rates to negative, they're gonna destroy the dollar's magnetic ability to draw capital in, and that would be a disaster. So I think the Federal Reserve's hands are tied, because they also have to protect the reserve currency.
Interesting. That's going to be interesting to see how that all plays out. And so, like, as far as the idea of when we reach that, recession category territory, the only thing they're going to be able to do, or you would think, is just going to stimulate of some kind. Stimulate as far as just begin printing type of thing. And then, won't you think that it will erode the confidence of those that actually purchase, our debt? They're going to eventually say, hey, you guys are just going to print your way out of it. Maybe I don't really want this anymore.
Yeah, I think that's their tightrope. They're on a tightrope. They can't drop interest rates to negative, because that'll destroy the dollar's, like I said, its ability to attract capital. But if they don't stimulate, then the economy slides into recession. So this is why, and you mentioned the term earlier in our conversation, helicopter money, and we should say what that is, I guess. And at least in my understanding, it's the central bank tells the government, hey, go borrow $1 trillion, we'll buy that debt from you, and then you go give that $1 trillion to households. You cut everybody a check for $1,000 or whatever, and you're basically dropping money from helicopters on every household. Now that's they tried that in a small scale back in 2008. Remember, we all got like $300 or something.
Yeah.
And I don't think that was enough to move the needle. I mean, that I don't know. I probably use it to pay down a credit card or something.
I know. I believe I did pay down some type of debt or something.
So the thing is, it's going to have to be a lot of money to move the needle. Like, they're going to have to give every household $3,000 or something serious money. Well, then you're starting to talk about trillions of dollars. So I think that's very likely, because there's really no other way. If you can't boost wages, well, then you're just going to have to start giving money to households, right? And so, and that'll give a little initial boost, but are you going to do that every month from now until doomsday?
Yeah.
And so that's where that policy falls apart. It'll be nice. It'll keep the economy going for a little while because we'll all get that little boost. But then what happens in the next quarter and the next quarter? And so then you're going, well, is it permanent? Like every month the Federal Reserve has to borrow another $1 trillion from the government so that they can issue another $1,000 to every household. So anyways, that's the problem with helicopter money is it's good as a one-time stimulus, but if the economy depends on that to keep afloat, well, that's not going to work. So I don't know if that really answered your question.
Yeah, it does. It does. Now, like, I want to, last question or two as we draw down towards the end of our conversation. Now, political season, election, debate, things like that coming up. Do you think the policy being implemented, when the official recession will be announced, will kind of sway towards, if it's Hillary, it'll be more favorable, or if it's Trump, will he interrupt and kind of, put an end to some of their, manipulation? How do you foresee, like, the decisions being made by the Federal Reserve playing along with this upcoming election and who's chosen as the next president?
Yeah, that's an excellent topic, and of course we're just speculating.
Yeah.
Amongst us in the alternative financial world, you see people trying to figure out which one is going to collapse the system earlier. That's actually a benefit.
Yeah.
so that's, if you think that Hillary will collapse the system quicker, then vote for her. If you think Trump will do it, vote for him. The Federal Reserve it's really on this tightrope that we talked about. And so in a way, it doesn't really matter who's president because the economy is going into recession and there's not much anybody can do about it because the forces at work are so much larger than some announcement by whoever's president, right? And so in my mind, the only thing they can do is they can do helicopter money, which would give us a little quick boost that might put the recession off for like a month or two, right? In other words, if they give us all $1,000, well, that'll help the economy. But it's not going to fix the problems because the problems are deep. They were over-indebted, wages are stagnant, small business is crushed by regulations, and corporations, own Congress. And, all these problems are the ones we have to solve. And so I don't think that any president can really deal with those. They can talk about it, and that's all they can really do. But it's going to require a complete change in our mindset and a lot of changes that are going to take power away from the top of the pyramid and distribute it down to the bottom of the pyramid. And everybody at the top is going to resist those changes for obvious reasons, right?
Right.
I'm going to try to protect my $1 billion.
Now, last question. I know it could require a lot more than which we've covered a lot within this question. But your most recent article that you wrote about the 3 stages of empire, and you mentioned that we're in the final stages of decay. Can you just summarize that briefly on just the entire article, which it was quite lengthy. I would encourage people to go to your website and read it for themselves. But what's the decay and how does it end in Charles Hugh Smith's mindset? How does it all come to an end? How's the game, how's the rig or the gig up?
Okay, well, great topic. I think what we've seen in history is that, this particular book was about the Roman Empire, we all know a little bit about that, is that when the people in power, when their mind changes from serving society to self-serving, in other words, just maximizing their personal gain out of the system, that's the trigger for the collapse and the decay and the decline. Is that when everybody's lost the ability to focus on maybe the work or sacrifice they need to make to benefit everybody in society, and they focus totally on maximizing their private gain, that's a source of decay, because then every decision in that process is all about, how can I get maximize my share of getting out of this thing. And we see it in bureaucracies and defense contractors ripping off the taxpayer, to maximize their gain on some weapon system that doesn't even work well. That kind of stuff. It's like friction. It's like throwing sand in a machine, right? Every grain is out there trying to maximize their own benefit without any regard to the cost to society. And so what happens, of course, is the engine freezes up. And so we're going to have a point at which there's maybe inflation takes off and there's no way to fix it, and or the currency has some kind of currency crisis where people lose faith in the thing, they lose faith in the central banks, and then that will trigger a political crisis because people will go, well, you know what, I don't feel I've got a positive future here, right?
Right.
And so then you got a political crisis, and those play out. They can play out positively, you know, if people recognize and kind of wake up and, hey, we have to take care of all of our society, right? I can't just focus on my own benefit here. We need to get together and fix the problems for our entire society. Or it goes into warring camps where everybody's turned against everybody else and deteriorates really badly. And so, and of course, we individually can't control that whole process, but we can put our voices behind, hey, let's fix our real problems. And they go way deeper than this interest rate, the central bank, or who's president.
Right. Well, Charles Hugh Smith, I appreciate you taking time to sit down with us. Can you let the audience know, for those who are not familiar with you, where they can find you and what they can, expect from your writings and things like that?
Well, thank you, Mike. It's visit me at of2minds.com. You can read samples of my books and look at my archives and see what's on my mind.
Well, thank you. It sounds good. Look forward to staying in touch with you, and we'll we'll keep our eyes on what's going on and hopefully come out good on the other side.
Well, thank you so much for some excellent questions and topics.
Well, thank you.
Appreciate it.
Appreciate you coming on. Thanks.
Well, this concludes today's conversation with Charles Hugh Smith from of2minds.com. Hope you guys enjoyed this conversation. As always, if you found it to be informative, I want you to share it with family and friends to help them become more monetarily aware of things happening around them, as well as click the subscribe button to get more RTD News interviews as well as monetary news updates. Looking forward to bringing you more interviews. Until we meet again, thanks.